Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hello and welcome to Better System Trader. Thanks for joining us for this week's Trading Thought. A few weeks ago, I got the fright of my life. I found myself in a situation where I could potentially be crushed by a car or perhaps even a bus or truck. As I've mentioned in the past, I like to go riding on my mountain bike. And when I ride my bike, I like to go pretty fast, and I do things that perhaps a casual rider may think is a little crazy, but I very rarely go for a ride where I'm just cruising along at a leisurely pace. So, true to form on this particular day, I was hurtling down the street like a missile. However, I didn't realise I was about to find myself in a situation that could potentially put my life in danger. At the end of my street is, it's a pretty busy road. It's one of the major roads for the suburb that I live in. And as I mentioned, I was racing down the street, and as I approached the intersection, I squeezed on my back brake to start slowing down. But as I squeezed the brake lever, barely anything happens. I hardly slow down at all. So I squeeze the brake lever more, and then as hard as I can until the brake lever can't go any further, but I'm still not slowing down. And now I'm much closer to speeding into oncoming traffic. This brake just isn't working at all. Now, luckily I've still got the front brake. However, it can be dangerous to try braking from high speed with just the front brake. I could easily, brake too hard and end up flying over the handlebars onto the road, which obviously isn't a good situation to be in either. Anyway, I managed to stop just before I get to the traffic, and I take a quiet moment to pause and reflect on what's just happened. And then I remember. Over the past few months, my back brake had started losing its effectiveness. In previous rides, I'd noticed that I had to squeeze the brake a lot harder to stop, and I'd even considered taking the bike in for a service to get the brakes fixed. But it had slipped my mind, and on this day, I'd completely forgotten about it. So I was aware of the brake performance degrading, but I hadn't kept track of it until it was almost too late. One of the challenges we have as traders is keeping track of strategy performance and trying to determine when a strategy has degraded enough that it's time to stop trading it, or perhaps it's time to take it in for a service. Now, there are a number of metrics and techniques we can use to monitor strategy performance, and we've covered quite a few of them on the podcast already. But today I want to share an approach that can be used to measure not only how much a strategy degrades from in-sample to out-of-sample, but also how the strategy performance degrades over time, so you can determine when it's too dangerous to keep trading it. Plus, this technique doesn't do just that. It can also indicate if a strategy is potentially curve fit or over-optimized as well. Sounds pretty good, right? Well, let's listen to Perry Kaufman now as he explains what this technique is and how we can use it. I'd just like to change the topics a little bit to monitoring system performance or degradation. So as markets change, strategies move in and out of profitability. How do you monitor the performance or health of a system?
Well, you seem to only have difficult questions here. That's a question that people are still dealing with. Let me give you a couple of simpler answers to that. Every manager has to monitor the performance. Unfortunately, using probabilities, you can take a fairly big drawdown and still think that you're in profile for your historic performance. Obviously, you start with historic performance to get an idea of what the pattern is, how much money you should make, what kind of drawdown, what kind of risk you have. And you create, I always create an information ratio, which is the annualized returns divided by the annualized standard deviation. Two pretty simple calculations. Anyone can look them up. And that gives you the information ratio. So if you have done a robust system you should be able to get an information ratio between 1 and 1.5. If you get an information ratio above 3, chances are you've overfit your historic data. The systems can only be so good. I have had a system in the 1990s, a short-term trend following system, that actually had a real ratio of 3 over 8 years. And of course, we sold that to ED and F-Man at a big profit. However, the markets are much more difficult now. They were really easy. The markets went straight up in the 90s. We benefited from that. A ratio greater than 3 is a little unrealistic. It's possible. When you get a ratio of 4 or more, it's absolutely not possible. And so I would suggest that anyone that gets information ratios that high should reassess what they're doing. In reality, let's say I start with an information ratio of 2. And that's in sample, my tested stuff. In real trading, or an out of sample. So now let's say I want to paper trade it for some time. I would expect that ratio to drop from 2 to 1. And the reason it drops is that there are new patterns. You're now looking at patterns you have never seen before in slightly different ways than history. And your program just doesn't respond as well to those, even though it will make money. And the fact that it makes money is good. If it drops from 2 to 1, you consider it a success. So don't be scared off by that. It's just reality. It's in statistics, as you add data, you're going to have longer runs of profits, longer runs of losses. It's just like, coin flipping. The more coin flips you have, the longer the runs. It's all still random. So we have a degradation from 2 to 1 with out of sample. Now, when you actually start trading, you could expect more degradation because now you have costs and slippage that you probably haven't accounted for correctly. And so you could expect that to slip down to 0.75. Again, that's a very successful outcome because the stock market is down around 0.3. So if you're at 0.75, you are really very competitive. So you have to understand the numbers to know what's good and what's bad. And then you have to be able to accept the risk that goes along with it. Because a 0.7 ratio means that there are some pretty decent swings in performance. And it's just part of trading. In trading, you have to learn to embrace the risk of your system. You can't eliminate the risk. You can't go back over a system and say, oh, look at that trade. That was a bad trade. I can fix that by changing this parameter or adding a different type of stop loss or something. That doesn't work. You have to have a robust system. And I think the phrase that I like to use for that is loose pants fit everyone. If you have a system with very few parameters, it's has sloppy performance, but it works and gives you profits on most markets. And then you reduce the risk by diversification. That is the correct outcome. If you try to hone in on the profits and eliminate the risk, you're just kidding yourself. You eliminate the risk in one place, it pops up somewhere else. It's just not possible. So I would seriously suggest that if you come up with a system that is profitable and you add a parameter to it and it improves it, but it doesn't improve it gigantically and it doesn't improve it across all markets, don't use it.
Thanks to Perry for sharing details on how we can use the information ratio to monitor strategy performance and quantify how much a strategy has degraded over time. If you'd like to hear more from Perry, you can hear the rest of that conversation at bettersystemtrader.com/10. So thanks for joining us for this week's Trading Thought. I'll catch you again in a few days' time, where we'll be releasing the third episode in the mean reversion series with Cesar Alvarez, where he answers all of your mean reversion trading questions. So catch you in a few days' time for that one, and enjoy the rest of your week. Okay, well that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.